Hello student, here we study financial accounting from FY Bcom semester 1. In that our first unit is amalgamation of partnership firm. The meaning of amalgamation of partnership firm is it is a process of merging two or more partnership firm to form a new partnership firm. While the dissolved partners become a new firm's partner. An amalgamation is the combination of two or more companies into an entirely new entity. Amalgamation are distinct from acquisition in that none of the companies involved in the transaction survive as a legal entity. Instead, a completely new entity with the combined assets and liabilities of the former companies is born. Amalgamation means coming together or joining together of two business concern to form a single and bigger business concern. Usually two business concern having similar type of business or an ancillary concern. Joined together so that they can be established on a bigger scale than their original individual status. Under amalgamation, two or more firms transfer their businesses to a new firm which is formed to take over such businesses. Usually, all the assets and liabilities are revalued in order to ascertain the true position as on the date of amalgamation. Thus, we can say that two or more firms are said to be amalgamated when they join together, pool their resources and convert the business into a composite firm as a new firm or as a single separate unit. The term amalgamation has generally fallen out of popular used in the United States, being replaced with the term like merger or consolidation, with which it can be synonymous. However, it is still commonly used in certain countries such as India. Our next point is some reasons why company might amalgamate. We can say that the need of amalgamation. In that, our first point is reduce competition. To avoid cutthroat competition, company in the same industry might amalgamate their business. The second point is increase market share. It means companies might amalgamate to gain a larger market share. Then next one is improve profitability. Companies might amalgamate to improve profitability by increasing the level of operations. Then share resources. Companies might amalgamate to share resources and liabilities. Even also some needs or points are there is for creating a monopoly and leadership in the market. It create uh, the amalgamation to avoid unnecessary and unhealthy competition. They also amalgamate their business for achieving specific target or position. If joint efforts are required for that, company also amalgamate their business to become a big business, increase their capital to achieve mass production at minimum cost, to become monopolistic in a particular trade, to avoid large operations, to achieve targeted tasks by combining human assets having different qualities, to reduce unnecessary cost of advertising, to pool all the resources in right directions. These are some points for that company amalgamate or business amalgamated. Then here we study there have some types of amalgamation. In that, first one is in the nature of merger and second one is in the nature of purchase. While we are studying the types, first amalgamation in the nature of merger. Merger means two company merge their business and form a new company. A and B, for example, A and B wind up and forming new company named C. In this type of amalgamation, not only is the pooling of assets and liabilities done, but also of the shareholders' interest and the business of these companies. In other words, all assets and liability of the transferor company become that of the transferor company. In this case, the business of the transferor or company is intended to be carried on after the amalgamation. There are no adjustment intended to be made to the book value. The other condition that need to be fulfilled include that the shareholder of the vendor company holding at least 90% face value of the equity shares become the shareholders of the vending company. Means while we are studying the amalgamation on the basis of nature of merger, that time merger means combining two businesses into and form a new firm, means two liquidation and one formation. And The second type is amalgamation in the nature of purchase. This method is considered when the conditions for the amalgamation in the nature of merger is not satisfied. Some nature of merger may not be satisfied, that time this method will be applicable or applied. Through this method, one company is acquired by another company. Means if they have a strong company, they acquire to weak company who is weak by wealth, or by having they do not having some resources or required resources with them, and they are facing some losses in their business. That company is called as a weak company. And strong company means who having good liability, good asset, their insolvency rate is solvency rate is high. So they, that is a strong company, and strong company acquired to the weak company. Through this method, one company is acquired by the another, and thereby the shareholders of the company which is acquired normally do not continue to have proportionate share in the equity of the combined company, or the business of the company which is acquired in generally not intended to be continued. Then methods of accounting for amalgamation. Firstly, we study the types of amalgamation. Here now we study the methods of accounting. Which type of accounting method we used in amalgamation? In that, first one is pooling of interest method, and second method is a purchase method. Pooling of interest method means through this accounting method, the assets, liabilities and reserve of the company are recorded by the transferee company at their existing carrying amount. Here, the second method is purchase method. In this method, the transferor company accounts for the amalgamation either by incorporating the assets and liability at their existing carrying amount, or by allocating the consideration to individual assets and liability of the transferor or company on the basis of their fair values. Means pooling of interest method, whatever the existing amount is carrying forward, but in purchase method, there may be the fair value, they are calculating the fair value at the date of amalgamation. These two methods are used while amalgamation is done in the firm. Then there have some advantages and disadvantages of amalgamation. Yes, every point, every part of any thing, that they have some advantages and disadvantages. Amalgamations also have some advantage and disadvantages. In that, while we are studying the advantage, amalgamation is based on the concept of synergy. Synergy is the relationship in 2 is to 2 plus 2. So the effect of that, it is greater the sum of the parts. Synergic benefit can arise where two firms can achieve more in combination than one on their own as individual firm. In that, first point is reduction in cost. It means when two firms dealing in similar nature of business amalgamate their business, they cut down the cost of competition. Each firm before amalgamated has to spend a good amount on advertisement, packaging, sales promotion strategies and price cutting. The amalgamated firm can have operating cost advantage and have lower cost of production. The second point is monopoly. When two firms amalgamate, they capture a bigger market share, thereby create a monopolistic position for itself. It can enjoy the advantage of monopoly. The amalgamation can contribute towards strengthening the existing market leadership. Then third point is enjoy better financial status. The partner of both the old firm are now partners of one big new firm. This naturally gives the firm a better financial position and better opportunity for growth. Then next point is higher profit. Higher profit is all the above advantage leads to the main objective of amalgamation, that is higher profit. The amalgamated firm has a better financial and monopolistic position. Cost have been cut and the selling price increased, leading ultimately to higher profit. Then next advantage is also diversification. In an amalgamation, risk of the firm can be lowered by diversifying into two or more activities. Diversification is a situation in which a firm takes on new lines of businesses to spread the risk. Then next point is next advantage is managerial effectiveness. Effectiveness is a degree of attainment of a predetermined goal. Management effectiveness can be availed of through superior management talent or research capability. Then while we are studying the disadvantages of amalgamation, in that the first point is diverted day-to-day operations. Seeing a merger or acquisition through the completion is a huge undertaking. There is a large amount of research due to diligence and negotiating to be done before any contract are signed. As such, many directors notice how much of the direction uh, and M&A deal is to their daily operations. Someone has to put in the hours needed to ensure a successful acquisition. This is pulled away from elsewhere in the company. Because of this, it's strongly recommended to enlist the help of the specialist. Then second point is loss of jobs. When two companies merge, it can bring about scenarios in which certain job roles become redundant. A change in company structure or just a doubling up of position can mean that the certain staff are no longer needed. In many cases, these workers can be retained and implemented elsewhere. Sadly, this is not always the case, however, and job losses can sometimes be unavoidable. So, this one is also when the staff is more than their requirement, some people may be jobless. Then, the next disadvantage is loss of key staff. It means, of course, even if you take great care to ensure that nobody loses their job, you may well find several jumping ship voluntary. A merger or acquisition can be a time of great uncertainty for staff. Not only will they wonder if their job will be safe, but they will also be unsure as to what the job will look like. So, the uncertainty of their job security alone is enough to make many look elsewhere. So, if you are hoping to retain staff, it's worth having a conversation with them to assure them of their place in the company's plans. Then, next point is loss of moral. If staff were comfortable with their original role and workplace, any changes could be viewed unfavorably. The loss of certain members of staff can affect moral greatly too. This could either way, while the departure of the harsh supervisor or lazy non-team player can actually boost morale. The loss of a popular member of staff can be damaged if their leaving is attributed to one of the changes your business has put in the place. The next disadvantages is culture clashes. Uh, while this can obvious be an issue for the staff being forced to adopt new practices or accept new colleagues, it can also be a corporate problem if the business has positioned itself as a progressive place to work, but sometimes the company's culture may be disturbed, and so there have some cultural clashes. Then Macy brand identity. When two or more companies merge, there can be understandably be some haziness surrounding the identity of the consolidated business. Then overpaying. Valuing a business is not an exact science. There are myriad methods to value a business, and each is suited to some industries more than others. Then unexpected cost is also the disadvantage of amalgamation. Even the best laid plans can throw up the occasionally hiccup, and if you are due diligence checks aren't through enough, the purchase of companies can uncover several unforeseen costs.